It's another episode of Africa Business Weekly, your premier source for business news, trends, and insight from across the continent. I'm your host, Akin Obakeye. Hello and welcome. Where does Africa stand in the global trade wars as U.S. tariffs on Canada and Mexico take effect? We'll be discussing this and many more on the show today. Let's get the show started from the eastern part of the continent with Tabisa Mutoni.
Murakoze Chane Akin for thank you very much, as we say it here in Rwanda. Well, this week, East Africa experienced several global impacts, though not on a huge scale, as U.S. President Trump's tariffs on Canada and Mexico took effect. CNBC Africa's Abiagina had an exclusive interview with Kenya Private Sector Alliance Chairman Jaswinda Bedi for insights into the implications of this development in Kenya and across the continent.
I think we all need to be cognizant of the fact that we have a new sheriff in town, and the sheriff loves tariffs. And these were his election pledges, and he was very clear during his campaign trail that, look, he's going to be controlling unfair trade practices, which is what he called, with tariffs so that he can make America great again. We've seen a lot of movement. We've seen a 10% introduction on tariff into China as soon as he came into office. Another 10% was introduced this morning on the 4th of March. And 25% tariff was introduced to Mexico and 25% to Canada as well today. So yes, we have this huge trade war ongoing. I guess the Cold War has been ongoing for a couple of years now between China and the US. And so it's going to be interesting times for us because he's actually singled out his new directions to the USTR, asking them that we're going to be looking at all countries in the world. We're going to call it unfair trade practices. And if they're charging us tariff, we need to reciprocate with tariff. And America will no longer tolerate imports coming in at a reduced tariff so that they can maintain American jobs. So interesting times ahead of us for sure. Right. And yes, as you know, AGOA, which is the only trade agreement that America has with Africa, is going to expire on 30th September 2025. So in about 200 days from now, we are going to be, we'd either have to have a new trade agreement with the US, or if we have the status quo remaining and the trade agreement is not renewed, then of course there could be some challenges for exports from Africa to the US. I believe the only country on notice at the moment from USTR is South Africa on reciprocal tariff under the new Unfair Trade Practices Act, which he signed into law. So interesting times ahead of us, and I think it'll be interesting for us to see how things unfold. One thing is for sure, I think Africa as a continent, we are $3.5 trillion economy, we are 3% of world trade, we are inconsequential in the grand scheme of things. He's got bigger wars and bigger issues that he's going to address with the rest of the world. The US at $28 trillion economy, which is 28% of the world's economy, and second being China at 18 trillion, and the European Union, which is 27 countries, excluding the UK, is like 17 trillion. So there are bigger problems out there, problems in the Middle East, problems with Ukraine, as you all saw last weekend. So I think we are not in the radar of thought of any danger at this point in time.
Shifting gears to another transformative development on the African continent, we explored the potential of central bank digital currencies to reshape economies across the region. I spoke to Alexander Finney, managing partner of Chevenet, for more.
Digital transformation in central banks in Africa is certainly underway. I'll bet it is at the moment restricted to only a certain select group of countries. If we take Nigeria as an example, they launched their e-Naira a couple of years back. In very close by Ghana, we've also seen the e-Cedi pilot. And last week when I was in Kigali for the Inclusive Finance Forum, we also saw the signing of a licensed passporting agreement between Rwanda and Ghana. So these are some great examples of where we're starting to see digital transformation really taking place. However, of course, in a number of other countries, it is still, especially with regard to central bank digital currency or CBDC, it's still very early days, and these countries are very much still in the research phase. The challenge is really ensuring that digital solutions are accessible, secure, and scalable. So we at Chavinet have developed a series of tools, including something we call Central Banking 4.0 standards, which is a digitally native reference architecture for central banks. And we also have something called the Galactic Grid, which is an assessment framework for technology companies to help central banks to navigate the ever larger landscape of technology vendors that are out there.
And that's quite a number of challenges that you've pointed out there, and also the solutions that you've come up with. And I've noticed the scalability aspect there. So what are some of the banks that you're working with, and also help us understand some of the unique challenges that African central banks face when it comes to adopting digitalization and at the same time implementing CBDCs, and also maybe how Chavinet is, helping to address some of these challenges on a deeper scale?
So in Africa, you certainly have in some places infrastructure limitations, so mobile and broadband coverage. Also, there are challenges around financial literacy and trust. And then also you have the cross-border interoperability challenge. So if you have a number of different countries that are all developing digital currencies using different protocols and approaches, this is going to lead to interoperability challenges for cross-border payments in the future. And that will, of course, be exacerbated by the liquidity and FX challenges that you already have. So at Chavinet, we help central banks by performing digital infrastructure assessments. We can provide regulatory guidance. And of course, we help with education and outreach programs to help the underbanked to better understand what digital finance will mean for them and to help get them up to speed.
As we continue to witness these global shifts and innovations, it's clear that Africa is positioned to play a pivotal role in shaping the future of both global trade and digital finance. That's it from East, back to the West.
Murakozeshane Tabita. Let's join Karabo as she fills us in on developments from Southern Africa.
Thank you, Akin. Africa's largest stock exchange raised its ordinary dividend by 5.8% in the year to December, resulting in total distribution to shareholders of 715 million rand. The JSE said revenues across most its asset classes grew in the period, helped by the positive market sentiment since the formation of the Government of National Unity in South Africa. For more on these results, CNBC Africa senior anchor Fifi Peters spoke to Leila Fourie, who is the CEO at the JSE. Let's listen in.
We haven't seen any massive negativity as we have in some of the other markets year to date. So if we look at what the indices have been doing, last year we really surged after the announcement of the GNU, and the all share ended up 9.4% up. Compared to the MSCI Emerging Market Index, which was only up 5.04%. Now, as at Friday, we were 2.2% up, and today our markets have just closed another 2% up. And if we look at what's happening in the NASDAQ, the S&P, NASDAQ is in negative territory. S&P is in sort of 1 to 1.5% up. So the JSE is actually faring a lot better than one would expect. When the budget speech cancellation was announced, the dollar, of course, took a slight backward step, but then it bounced back later that day, and it in fact improved. Today, the dollar has weakened somewhat off the back of a strengthening US dollar generally across all markets. But if we even look at the activity in our market, so the average daily value traded, our average daily value for traded for the year to date is up 45% on prior year, indicating a lot more activity. If you look at the bond market, our bond market is net positive by 24.5 billion rand year to date. Last year, this time, we were net positive just under 2.9 billion. So yes, there is a lot of volatility. There is a lot of uncertainty, macroeconomic and economic and political. And we are starting to see a confluence of economic and political data. And this is starting to play out in major stock markets. Many economists and analysts are suggesting that we should follow Warren Buffett, who has an increasing amount of his assets in cash. But the JSE is doing reasonably well. The JSE limited share price outperformed all headline indices last year. Off the back of positive sentiment in the GNU, we were up 30% for the year, and our overall total shareholder return was 40%. And so the JSE is often seen as a barometer and a bellwether for the broader economy. So we are starting to see a much more open-minded investment appetite by internationals into South Africa. But all eyes are on the GNU, and particularly on our ability to grow.
Of course, Leila, and there's some great color there that you shared in terms of the increase in the average daily traded volumes, as well as what you're seeing in the bond market. But if I just go through some of your revenue line items as reported, I mean, you have improved your JSE investor services by 20%, primary markets also up 15.6%, commodity derivatives trading up 12%, and also an increase in revenue, as you have alluded to, in terms of the bonds and financial derivatives in the high single digits. But then you circle over to what's happening with equity trading, and that barely rose, up just to 0.2%, and also equity derivatives trading contracting in the period. How should we interpret that? I mean, what's that indicative of?
We saw a very slow start to the year in the cash equities market last year, largely investors with a wait-and-see appetite up to the GNU. Post-GNU, we saw a rally in market activity, but that was not enough to offset the very negative first half of the year. So we ended up by 1% on average daily value traded. We have seen that surge in sentiment continue. In the equity derivatives market, there was investors were shifting to a more balanced position from what was previously an underweight position. And so we did see a lot less hedging activity. A large part of that business is in the index trading space. We did see a pullback in the equity market, but it was largely a tale of two halves, so largely limited to the first half of the year. And then, of course, there was a lot of uncertainty just pre the US election. We saw quite a big outflow in the equity market in October of last year, and that was really off the back of what was anticipated to be an interesting outcome in the US election.
And in more news driving Southern Africa, we now turn to the latest RMB BER Business Confidence Index. The index held steady at 45 points in the first quarter, slightly above the long-term average of 43. However, this still signals that more businesses remain pessimistic about current conditions in South Africa. Earlier this week, my colleague Zanella Morrison spoke to John Kearns, who is the head of research at RMB. Let's listen in.
The RMB BER Business Confidence Index for the first quarter came out at 45. Just to indicate what that means is 50 is the neutral level. So the net number of positive versus negative, slightly below the 50 level, was also at 45 in the fourth quarter of last year. So business confidence is unchanged. However, note that it's not nearly as pessimistic as it was a year ago. The change in the GNU has given a bit of a rise to business confidence. And then within the business sector, we see different type of companies, different levels of confidence. What really came through in the first quarter, and we've seen that reflected in other figures, is that the motor vehicle industry is becoming more optimistic about the outlook. If you look at some of the other sectors, just looking down here, manufacturing very weak, building pretty weak as well. So it's just selected areas in the economy, a little bit more confidence. Overall, businesses not nearly as pessimistic as they were a year ago, but you can't call them very confident at this stage.
I see that building contractors remained quite positive, and they're an interesting line item because they're a reflection of what households are intending to do, and they're also a reflection of how the suppliers to the building industry will perform. Optimistic about future activity, but a little bit disappointed about current activity?
Yeah, fair enough. We also saw that come through in the GDP figures. Construction was down again. Business investment is down. Residential investment is struggling. More broadly, what the GDP figures showed, and indeed what this now our business confidence index is showing, is there's some optimism on the demand side. So the motor vehicles, as I mentioned, but generally retail as well. We saw that 1% growth in personal consumption expenditure in the fourth quarter GDP. So it's the two-part, it's the rate cuts feeding through into the consumer. So just the businesses that deal with consumers directly are seeing some of the benefit, but that hasn't yet spilt into the broader economy. We at RMB, we're still hopeful. We're still expecting that a demand-led recovery from the consumer on the back of low rates, etc., will start to spill over more broadly. Also, it's worth just thinking about when the survey was conducted. The survey covered the period where Trump did the executive order on South Africa, but it did come before the lack of budget in South Africa. So I'm actually fairly surprised that business confidence has held up. Didn't really take a negative hit from the Trump's executive order on South Africa. Load shedding as well. Remember, we had a return of load shedding. So no further deterioration, but again, not a surge in business confidence.
Well, those were the stories driving the Southern African region for this week. It's back to you, Akin.
Many thanks there, Karabo. S&P Global Ratings has lowered its long-term foreign and local currency sovereign credit ratings on Senegal to B. Now, the ratings agency also affirmed the West African country's short-term sovereign credit ratings at B. Mika Vidal, lead analyst on Senegal and director of sovereign ratings at S&P, unpacked the latest ratings on the West African country. Take a listen.
The situation is actually much more deteriorated than what we had initially anticipated, with deficits for the period spanning from 2019 to 2023 that are actually doubled what was initially indicated in the budgetary document. So thus, as a result, the level of debt to GDP is at 100% for 2023 and should even go higher as per our forecast in 2024. The rating action, is underpinning is underpinned by the fact that we believe the fiscal consolidation path that the authorities have indicated they will engage in looks extremely ambitious, and that for a series of reasons. I think number one, they've indicated they wanted to reduce deficit by 3% by 2027. And they're starting from 11% of deficit in 2024. So the path is long, and in fact we have a more conservative base case with a deficit reaching 5% by 2028 only. Secondly, this effort in itself can harm potentially the country's growth prospect because it's just so massive. And thirdly, I think the reason why we doubt somewhat this very rapid consolidation is that the flows identified in the budget, in the budgetary process, will take time to be sorted out, and it may actually create some execution risk in the governance strategy to to execute, the consolidation path envisaged. Sorry.
Right, but the government is also planning to engage the IMF this year, in June this year, I believe, for a new program. But you believe that obviously both parties, the IMF and the Senegal authorities, need to come up with a new economic and budgetary plan. But you're also not too confident on that they can agree on something solid in good time. Could you help us understand that?
Yes, absolutely. In fact, we believe there is a fairly high likelihood they might agree on the new program with the IMF, but there is a matter of time. There is a question of time frame. We believe the June 2025 target that they've set for themselves is quite ambitious, notably because the IMF needs to go through its own review process after this misreporting happened. So that looks somewhat ambitious, and we see that as a big challenge for the authorities and also the IMF, because there is a significant funding associated to this. The program that has been suspending, just so that you know, was representing 1.8 billion in USD terms, right? And this comes in a context where the country, Senegal, as per its 2025 budget, about 4.6 billion equivalent of debt amortizing this year. So that's a significant amount, and this IMF program is I think is absolutely key in restoring, notably, the credibility of the fiscal consolidation path and funding strategy of the authorities.
In other developments, the Director General of Nigeria's Security and Exchange Commission, Emomotimi Agama, has stressed the crucial role of the capital markets in economic growth, stating that the 2-week benchmark for companies to secure capital raising approval is in the bid to facilitate formation of capital. The markets regulator also states that efforts are ongoing to review and pass the rules on regulating the fintech space by June this year.
The time to market is a very essential part of every capital market, because what is critical for every operator and even the issuer is certainty. The ability to say specifically, this is what I want to do, this is when I want to do it, and of course, gauging the sentiments of the investors. So you just can't come to market at any time. No, it's a planned process. And that planned process has to tally with what the regulators also do. Prior to now, we've had some very, bad experiences for market operators where, issues are not approved for 1 year, 6 months, and all sorts of stuff.
Means all this board strategy out of the window.
Exactly. So it tells you, what exactly are we doing? And for us at the SEC, the current SEC management, we believe that we are there to serve. The essence of being regulators is to facilitate, capital formation. How do you facilitate capital formation when you are a clog in the process of, facilitating capital formation?
Yeah, because at the end of the day, you need to understand that the capital market or the strength of the capital market ties in a lot with the economy. And if we're aspiring for higher economic growth and all that, then the inner workings of the Security and Exchange Commission definitely should tally with what the business community is trying to achieve.
Very well. And that's why it's said usually that the capital market is the barometer of the economy. It is actually the engine of any economy. Check out any economy that is not doing well, and just oppose it with the capital market. You'll find out the reason why that market, that economy is not doing well. We are the producers of long-term capital. Every economy that roars upon the base of long-term capital, the availability of long-term capital. And once that is not available, then, of course, everything is thrown through the window. So for us at the SEC, that is very critical. Having looked at all that has happened, and having been at the SEC for the time I've been at the SEC over 22 years, it's important to understand exactly the mindset of the market. What do they really need? Certainty. And we looked around it and said, okay, what can we really do to help this process? And what we did was speak to the people who are involved and say, look, get your documentations right. And the best that could ever happen is that you have a 2 weeks delay. So time to market at 2 weeks does not even really mean 2 weeks. It could be 5 days.
Even less.
Yeah. It could less. But our maximum is 2 weeks. It can't be more than 2 weeks for any reason whatsoever. It is either it is approved or it is not approved. But if there are good documentation, there is no reason why it should not be approved. Hence, engagement with the market operators is essential. Speaking to the stakeholders, knowing exactly where the pain points are, and helping them to deal with those problems.
And that's all we can take on this week's episode of Africa Business Weekly. Keep a date with us same time next week for more insightful and in-depth analysis and news on Africa's dynamic business landscape. Special thanks to my colleagues Karabo and Tabitha. I'm Akin Obakeye. Do enjoy your weekend.